Hi, welcome to another episode of Trading Corner. So we are kind of discussing the market now post IE week last week. So there are quite a few market moves, I would say, over the last kind of 7 trading days. Obviously, the geopolitical tensions, sanctions, kind of de-escalation chats are still occurring, very much still up in the air, right?
Yeah.
But it does feel like we're having a bit of a shift in the financial kind of sentiment, especially in Brent flat price. So maybe we start there. I mean, flat price, it was probably the talk of the show last week, right? But how does it actually impact the markets? I mean, right now we're kind of in a state of high refinery margins, softening flat price. For us, the crude diffs are starting to improve a little bit again. But it's whether this flat price sell-off can sustain and if it makes sense. What do you think?
Yeah, I guess from my perspective, I'm just kind of trying to be aware that we're right in the middle of turnarounds now.
Yeah.
So if the crude market is going to feel oversupplied, now's the moment.
Mm-hmm.
So I'm just a bit wary we're having these sell-offs right in the middle of what I would kind of perceive to be the weakest moment for crude.
Yeah. But it's interesting that lead lag, right? Because you're right now we're kind of going into turnarounds, but when were these barrels actually kind of traded?
So that's always that's always the question, and like I think I always tend to go in circles on that, but
Yeah.
I think more often than not you do tend to see a dip in spreads in the middle of kind of turnarounds. So
Yeah.
and normally that's probably the moment when you want to start thinking. I mean, I'm not advocating to necessarily buy it, but I think that's the moment when normally you'd want to be starting to look at it the other way.
Yeah, no, I would agree. I guess the only thing I would say potentially is we kind of had that last week and the week before. Like, really, I think that was kind of the time to buy, which it does feel like a lot of the market did for everything except flat price. So flat price has kind of been its own beast, and, you know, arguably, it's kind of not really that related to the physical market, so it's a lot more spec-driven and financial-driven. You know, we have a lot of funds in it, so typically it will have more of a correlation with everything going on geopolitically.
Yeah, I agree.
Whereas the physical markets, that's going to move the Brent spreads, it's going to move the cracks, and it's going to move the GFLs. So right now, it feels like, you know, the financial markets generally, like globally, to be honest, not just in oil, right? Like globally, we're having kind of a risk-off mentality. Yeah, I think even, was it Buffett's fund is like liquidating the most
max
position.
cash, yeah.
Exactly. Like it's really indicating that actually the global markets, tech stocks, whatever, oil stocks, etc., they are just a bit too elevated. Or we're going to, you know, have a correction down, and then probably people are going to look to buy the dips there. So I think we're seeing that play out a bit in crude. Since kind of the tariffs came in mid-Jan, where we spiked, I think, up to like, I think maybe it was $80 a barrel. We've had this continuous sell-off, you know, day after day, and we're kind of hitting through 70 now. And personally, I don't think that's going to change. I think we're still going to see that financial pressure from the wider markets into flat price. So let's see how that plays out. Obviously, you're going to have correlation with what's going on in the news and with what Trump's doing. But generally, I think the market thinks that we are going to have a resolution at some point, right?
Yeah.
Zelensky's kind of backed up into a corner, it feels like. But no, you're so right about the run cuts, the market looking forward. So what are we seeing in the cracks? Are we seeing
from the margin
still?
side, they look very strong, particularly on the CDU. So basically, if your refinery is online and you're not in a turnaround, like you want to be max running, even if you're kind of even if you're producing too much product to fill your upgrading unit. So that's quite a healthy environment for crude as we come out. Assuming margins stay where they are, there should be healthy demand for crude as we come out of turnarounds. But there's been some interesting moves on the individual units. So based on my numbers, I think FCC margins in Pad 1, so like New York Harbor, look potentially negative. And FCC margins in Europe have been coming off. So maybe they're still positive in Europe, and kind of talking to refineries here, that it sounds like they're not negative yet. But I would expect there's potentially some trimming. I would have thought trimming in the US and probably some FCC run cuts or trimming in Europe. So as a refinery, potentially now you might be making 0.5 fuel oil rather than max running your FCC.
Okay.
And that may be why we've started to see a bit of weakness come into 0.5 fuel oil. And also in the East, it's been a couple of weeks since we had this chat, but between then and now, cocoa margins in the East went negative. I can't remember if we talked about them in the last session, but 380 in the East went so high that there was basically no incentive to process fuel oil.
Right.
And they look pretty weak here. So since then, we've now seen a move back down in fuel oil cracks, and the coking margins have increased a bit, but they still look pretty bad. So it's quite an interesting dynamic. Basically, the market's kind of saying max run your CDU and potentially don't run your FCC and your cocoa, which isn't kind of a normal scenario.
Okay, interesting. So, I guess what does that mean for like the switching of crude grades that's going to happen? Or should it not matter? You're just not running your secondaries.
When fuel oil was so strong, and like I think there was potentially even a positive CDU margin in the East running Dubai. I mean, it kind of means you're happy buying those grades. But yeah, I mean, I think if your coking margin's gone negative, it probably reduces your appetite for heavier barrels.
I guess it's coming at a good time because the East are going into maintenance in April, and I think a lot of the US kind of Gulf Coast refiners are. I'm not sure about the New York Harbor refiners, but it's coming at a good time, so they can probably slow down their kind of crude purchases. But to be honest, where Europe's maintenance season is just 1 month before, we had that sell-off in February, kind of for March loading, about 2 weeks ago, and these diffs were really struggling to get kind of above parity convincingly at all. I think we were kind of like highs of +10, lows of -10, but you're so right about the margins. You know, they were particularly strong. Makes sense given the turnaround. So what we've actually seen is one major has come in and kind of taken advantage of that, and he has a huge refinery complex, so he's able to kind of put barrels in a lot of different refineries and take advantage of the low prices and really do kind of a ball play on dated, essentially. But that has been supported by, I've seen a couple of other refineries, like some Italian refineries, Northwest European, like all of them are slowly coming in and starting to buy now, kind of for late March, early April cycles. So yeah, it's so true. When people think of maintenance, I think they think that, well, sometimes it can be exaggerated, like, oh, there's going to be no production by these guys. They really don't want to buy any oil. But that's not true. They still have some capacity.
Well, you wouldn't shut down all your refineries at the same time. So.
Exactly. So, like, it's not as though one month a refiner's buying 10 cargoes and the next month they're buying 0. It doesn't play like that. But I think what happened this time was everyone was waiting to get the cheapest price possible. And now they're kind of scrambling a little bit. The question is, going into the next couple of weeks, is whether this strength is going to be sustained. And looking at the wider markets, it does feel like you potentially want to hold everything in the front. And what I mean by that is we've had this problem kind of all year, the last 2 months. Just the confidence and the sentiment isn't particularly strong. So when everyone was selling cargoes, no one wanted to buy the paper, and now everyone's buying the cargoes, everyone wants to buy the paper. It just feels a bit fickle. So, you kind of want to keep everything like fairly hedged, because if this geopolitical stuff does come to fruition and we get a whole load of Russian cargoes come out and OPEC cargoes in April, it could lead to a very oversupplied market. But for now, in the current state, with margins where they are, dated where it is, I think the front of dated is going to hold. So let's see. I mean, the diffs have climbed back up to like 90 cents, which are very, very healthy. Now it's just a matter of economics. So So I'm ranting a little bit here, but so Dubai has sold off quite a lot this month. I mean, they've already done kind of March and April cycles. They're looking at the next, where are we now, March, April, May cycle. But it is considerably lower than last month. And the reason why, like a lot of what's helped dated was that open arb into the east. So for April cargoes, I think we traded around 3.25. So the arb was wide open at some point. I think a VL has been booked, it really helps bring up dated. Whether that's going to sustain into next month, especially with maintenance, I think it will be a bit tricky.
Yeah, I mean, we might also find that just the European demand for crude kind of picks up as well. So, I mean, typically from March kind of through to June, we should now be having like 4 to 5 million barrels a day of refinery capacity coming back online. So, I mean, potentially that's a pickup of like 4 million barrels a day in crude runs. So,
yeah. But is the product demand there?
at the moment, I think you have to go off the margins, and the margins look okay. I think that's a function of we're in turnaround. So, yeah, I think the big question is when refineries bring back runs, will the margins be sustained? Because demand's probably not that great on the product side.
I do think this dated rally is really going to punish the margin. I don't think the products will be able to keep up as much as dated is currently rallying, which is kind of why I'm suggesting to hold dated in the front and then potentially sell like futures contracts against it.
I'd be the other way now, actually. I mean, I don't trade structure because I'm so bad at it, but I think it's kind of beginning to look cheap, like some of the deferred future structure.
Yeah.
I mean, yeah. So personally, I'd potentially be the other way on that, just because, like as you're saying, the
I mean, I don't
strong.
think you'd want a short dated in the front.
No, but it's high, right? So it implies even in turnarounds, we've still been fairly.
It is high, but like now, I mean, once one person has taken the whole program, like it can kind of go to the moon a little bit, especially when people are scrambling.
But will they not? I mean, they've done that now in the middle of turnarounds. Like I would have thought. I mean, that's quite possible. You know, could happen throughout the summer as well. So.
Yeah, that is true. I think the only caveat is, you know, if, as I said, if all the arbs shut and we see a whole load more of Midland entering into Europe, in that case, the front will come under pressure. But to be honest, this French refiner wouldn't do it unless he was like willing to take a lot of TI cargoes. So I mean, the market is suggesting that we're fairly tight in light sweet now. Although I kind of had differently last week. I just met with one big Asian refiner, and they were kind of suggesting that every meeting they went to, they were trying to be flogged CPC cargoes. I think they had a production increase an extra like 300 kbd a day, and it's really like kind of hit the kind of Northwest European market.
Yeah.
But so there might be some switching going on between TI and CPC if the diffs get down enough, but it still feels fairly fragile. I don't know if it's, you see the chart of flat price and it's like consistently every day coming off. So it's hard to have this like fully bullish mentality.
It takes time as well, but you also, as price falls, you do see a demand response, and
that's true.
That's predominantly in gasoline. So, I mean, let's say if you pull like an India gasoline demand chart versus price, it's quite responsive. So.
Yeah. And also a lower flat price environment does, I mean, I think we've seen it kind of the last few times flat prices really got down to like 69, 68, etc. We do see a whole load of Chinese buying and flat price come in. It's just whether they have the volume to take on all these financials if they do start liquidating.
Yeah. But also the financial flows, a lot of that's probably trend following. So it's not, I don't think it's particularly strong flow. So like the moment things that look like they're picking up, the financial flows probably flip the other. I mean, there may be some of that that's like macro based, and they're doing that off economic things, and that's probably a bit more sticky. But a chunk of that cash is simply trend following, and that will, the moment it looks more bullish, that would just kind of flip back to long. Yeah,
potentially. As I said, I think it will probably have more of a correlation with the sentiment in the wider markets. But yeah, of course, you do get some funds, as you said.
I'd just be super wary. Like the sentiment in the market now, peak turnarounds. Like, I mean, I may well be completely wrong, and it has felt quite bearish. But I'm normally quite hesitant to get bearish in the weakest physical moment.
Yeah. which is fair enough. I mean, for us, we're seeing very strong physical, so it's kind of all down to the products now. Are the products going to allow for the market to stay elevated?
So I think the way you have to trade that is I reckon. Well, I think you have to follow the margins, and the margins are good. But I agree that's for me the worry is that runs come back, crude strong, and then we have a fall from the product side because actually demand's not there.
Because I am actually bearish margins here, personally.
I think you're probably right. Yes. Yeah. Coming out of turnarounds, it's probably bearish margins. Yeah.
Yeah. Okay. Well, I guess to sum up, maybe let's do a top 3 kind of trades. I mean, I think it makes sense to suggest more bearish flat price. You obviously don't have to agree, but I just think until we have, well, there are a lot of looming things. We have OPEC, we have the Russia production, and we have risk off in the macro markets. I think that's all going to hit flat price. Perhaps like a basket works better. So against that, I'd probably do long GFL. I just think the, more crude purchases coming up. Margins at the minute are healthy, so I don't see any downside there at the minute. And I would go short cracks.
Yeah.
Probably a basket of cracks.
I think that's an interesting trade. Like I hadn't coming into this, I hadn't thought of that, but I think that could make a lot of sense. Coming out of turnarounds into summer, we're going to be going into max runs with probably not particularly good demand, so that could be. Okay. I think that could be an interesting trade.
So maybe, given your the FCC stuff, maybe we suggest short fuel crack. Probably makes no sense.
Selling summer fuel oil cracks is quite punchy. So I'm not gonna.
What about April?
Yeah, maybe, but it's a bit too prompt for me. I would just keep it super kind of generic, and I'd probably sell like a summer CDU margin. So, I mean, you're selling diesel, bit of naphtha, and a bit of fuel oil.
Yeah.
And you're buying the dated in the summer.
Yeah, that works.
So yeah, that could be a nice trade.
Oh my God, we've agreed on something for once. Perfect. Okay, let's catch up in a couple of weeks and see how they did.
Thanks.